Good morning, students. Welcome you all once again in the video lecture, or I would say in virtual class by ICAI. So friends, today we are going to talk about conceptual framework for financial reporting. You must be wondering that what this framework is all about. In financial reporting, we have only heard about Indian accounting standards, right? Ind AS. But what is the meaning of this framework, conceptual framework for financial reporting, right? Friends, have you remember when you entered in class 1, class 2, class 3, so in your school days, so the teacher gives you syllabus, right? The first syllabus will be there. Then there will be a lot of subjects, right? So students, if I talk about this conceptual framework, right? This framework is something which talks about that how these standards are based out, how these standards are formed, right? And to talk more about this framework comes before the standard, right? Let's say this framework is nothing. It's a kind of a boundaries, right? It's a frame. It's a kind of a boundaries, right? On the basis of which, on the basis of, on the basis of which Ind AS have been drafted. Ind AS have been drafted, right? Sir, what does it mean? Friends, in 2018, you all know our Indian accounting standard are based out of IFRS. IFRS is a global concept. Ind AS is an Indianized version of IFRS applicable to India. Ind AS is a Deshi concept, Indian concept. Okay. In 2018, International Accounting Standard Board comes with conceptual framework for financial reporting. Conceptual framework for financial reporting, right? In 2020, our ICI, Accounting Standard Board of ICI, comes up with this framework. Earlier, it was framework for preparation and presentation of financial statement. Now, the new framework in line with IASB was introduced in 2020, right? The same framework, conceptual framework for financial reporting. Sir, this conceptual framework for financial reporting is used by whom? Largely, it is used by ICAI, Accounting Standard Board of ICAI. Why, sir? Because the Accounting Standard Board of ICAI is using this framework for drafting Ind AS standards, right? For drafting Ind AS standard. For example, nowadays there was a discussion going on for a new insurance contract standard, Ind AS 117. So it is not part of your syllabus. It has not been notified in India as of now, but sooner or later it will be notified, right? Within 12 months, you will see the notification. It is not applicable to your exam in this May or in this November. It is not applicable, but this Ind AS 116, the work on Ind AS 117, Ind AS 117 is going on. So if ICAI is drafting this Ind AS 117, or let's say you will say that, sir, our standard are based on IFRS, so we are not putting more effort on this drafting. IASB is putting effort on drafting IFRS. So if IASB is drafting any IFRS standard, then IASB is referring which document? भाई कोई document तो refer करना पड़ता है ना जब standard बनाते हैं तो, right? So which document needs to be drafted? Which document? Of course, we need to refer conceptual framework for financial reporting. International Accounting Standard Board refers conceptual framework for financial reporting for drafting any new IFRS, right? Likewise, ASB of ICI is also referring this conceptual framework for financial reporting, this conceptual framework, this concept for drafting a new standard, right? You must be wondering about, sir, if a company is preparing a financial statement, right? For example, Reliance Industries Limited, and Reliance Industries Limited is having a very big balance sheet, right? Very huge P&L. And if I talk about out of 39 Indian accounting standard, let's say around 30 Indian accounting standard is applicable to Reliance Industries. For example, PP, Ind AS 16, intangible asset Ind AS 38, financial instrument Ind AS 109, investment property Ind AS 40, right? Ind AS 1, presentation of financial statement, accounting policy standard Ind AS 8, events occurring after reporting date Ind AS 10, taxes Ind AS 12, right? uh, Non-current asset held for sale Ind AS 105, leases Ind AS 116, revenue from contract with customer Ind AS 115. So a single entity, Reliance Industries, is applying around 30 Ind AS for finalization of its financial statement. Now the question arises, sir, all these Indian accounting standards are on different concept. Means revenue standard talks about revenue, tax standard talks about taxes, PPE talks about PP, investment property is taking care of investment property, right? Intangible is taking care of intangible assets. So if these standards are different standards, separate standard, which is taking care of a different concept or different topic, but it is used by a single entity in one particular financial statement, right? So the question arises, in one financial statement, if we are following different Ind AS, then at least the basis of Ind AS should be same. The genesis of Ind AS should be same. It should be on the basis of a same concept, right? Which is known as fundamental concept, right? For example, if someone will ask you how this accounting, how these financial statements are prepared, you are saying that it is prepared on a going concern basis. This is a fundamental accounting assumption. Then you are saying that it is prepared on historical cost basis, or let's say you are saying it is prepared on accrual basis. What does it mean? It means whatever standard you will apply, the accounting is on accrual basis, right? And I'll take you 2-3 examples from different standards. For example, you have purchased property, plant and equipment. You have purchased a machinery, and you have purchased machinery on credit. What was the accounting entry? Machinery account debit to creditor's account. Machinery account debit to creditor's account. So friends, this is on accrual basis. You have not paid any cash. But in this case, you will recognize this machinery on the date of purchase. You will recognize an asset. You will recognize a liability, right? And this machinery is from Ind AS 16 PPE standard. Second example, you have sold goods on credit, right? You have sold goods on credit. What is the accounting entry? Debtor's account debit to revenue account. Now the question arises, sir, machinery was taken care of by Ind AS 16. Revenue is taken care by Ind AS 115. And Ind AS 115 as a concept says that when you go to the recognition condition, it says that when you have delivered performance obligation, means when you have performed performance obligation, when you have provided a service, in that case, you have to recognize a revenue. So Ind AS 115, revenue from contract with the customer, is more concerned about recognition of revenue when you have delivered a service. It is not concerned about whether you have got the money or not, right? Whether you have got the money or not. So talking more about this thing, if you will see here, this standard talks about transferring the control. This standard talks about delivering the services, right? This standard talks about the right to receive the money, right? So friends, if you look at all the standards, you will see that the basic premise, the basic underlying is same in all the standards, right? The standards are drafted in such a manner that it talks more about accrual basis of accounting. It talks more about going concern assumptions, right? For example, impairment. So impairment, when you read impairment standard, you must have read accounting standard 28 in your older days. But when you read Ind AS 36 impairment of assets, you will find that this standard has given you some trigger of impairment, right? And when you relate that Ind AS 36 with all other standard, you will find that these standards are on the basis of same premise. These standards are on the basis of same pillars, right? For example, if a person who got a birth in a Brahman family, or let's say in a Pandit family, right? And let's say there are 4 children of that person. So all the 4 persons, because they have seen the environment of worshipping God, environment of chanting mantras, so they have seen this culture since their birth, right? And they belongs to a particular family. So you will find at least the DNA, you will find the nature, you will find this devotion towards the God will be, of course, in some person it would be more, in some person it would be lesser, but you will find this thing in all the members of the family, right? Why? Because the basic environment, the basic fundamental on which they have placed is a particular fundamental, it is a particular framework. So friends, likewise, this conceptual framework helps the standard setters. I'm talking about standard setters. This conceptual framework helps the standard setters in drafting the new standard, in drafting the new Ind AS, right? This conceptual framework also helps the user of the financial statement, the preparers of the financial statement, to understand that if some accounting is not given in a particular standard, then how that accounting has to be done, right? For example, cryptocurrency. You will not find the accounting of cryptocurrency in any new Ind AS or in any standard, right? So you must have read Ind AS 8, accounting policy, changes in accounting estimate and correction of errors. And you must have seen in Ind AS 8, it says that if you have to finalize accounting policy, you have to refer a particular Ind AS. If you are not having a particular Ind AS, please go to the similar Ind AS. If you not have a similar Ind AS on that particular concept, then you should go to the framework. Which framework? That was talking about conceptual framework for financial reporting, right? So this framework gives you a broader aspect on the concepts of the financial statements, on the concepts of the financial statement. This gives you a broader aspect, right? This helps in formulating or drafting new standard from the standard setters perspective. For it, who is the standard setters? ICAI, right? ICAI draft standard, Ministry of Corporate Affairs notify the standard, right? Then it becomes the law of the land. It also helps the preparers of the financial statement, right? It also helps the preparers of the financial statement to apply the accounting concepts in those areas where a specific Ind AS does not take care about that, right? So this framework gives you underlying fundamental principles, underlying broader framework, right? For the purpose of applying or drafting Indian accounting standards, right? I hope this is clear to everyone. I hope it is clear to everyone. Yeah, great. Is that clear? Kochiki is asking, sir, conceptual framework came in 2018, but IFRS work came much before 2018. You are right, Koshiki. Prior to conceptual framework, there was a different framework. It was a framework for financial reporting, right? So globally, it was not like the framework was not there. It was there. Like in India, the framework was also there prior to 2020. These Ind AS were notified in 2015, right? So that time we have a framework for preparation and presentation of financial statement. This is a new framework. We have an old framework as okay. Yeah, sir. Whether questions will be asked about this particular framework? So there could be a theoretical questions, right? This is a complete theory based framework, okay? And most of the things you must be aware of when I progress on this topic. Most of the things you will be aware of, right? Third, the chances of having the question from this particular framework could be maximum 4 to 5 marks. It could be on a theory type, right? It should not be a practical type. It should be a theory type, okay? But sir, whether it is important to read this framework, answer is yes, right? Because when you read this framework, you will find that 50% things you are already aware of, right? So first of all, I'll let you know what is the agenda of this framework, right? And this framework talks about, you all are aware that Indian accounting standards are applicable on general purpose financial statement. I have told you in Ind AS 1 that these Indian accounting standards are applicable for general purpose financial statement. It is not applicable for tailored made financial statement, special purpose financial statement. It is applicable to general purpose financial statement. And general purpose financial statement are those financial statement which is applicable, which is used by the public at a large, which is used by the users at a large. So friends, the first thing this framework talks about the objective of general purpose financial reporting. The objective of general purpose financial reporting. What could be the objective of general purpose financial reporting? You tell me what could be the objective of. Let's say Reliance. Reliance is publishing their financial statement. Reliance is publishing their results, right? When Reliance is publishing their results, what could be the objective of those results, those financial statement? You tell me. So now for looking at the objective, for example, Viraj or Namrata, let's say you are the shareholder of Reliance. So what is your intention? What is your intention for looking at the financial statements? For taking the decision whether you should stay invested in Reliance or you should sold out the shares of Reliance, right? As an investor, as a shareholder, you want to look at the financial statement to see the statement of financial position, statement of financial performance for the purpose of taking investment related decisions, right? Government, what is the objective of government? The objective of government is to look at whether the company is complying with the taxes or not. And I'll give you a classic example here, right? There was a listed company. I will not take the name of the company, and this is a real life example which happened just 6 or 7 months back. Government has looked at a related party transaction of the parent company and the subsidiary company. Both were the listed company. So government has looked at that the subsidiary company is rendering a services to the parent company, and parent company is acquiring the services from the subsidiary company. So government has seen what amount of revenue from this parent, this subsidiary is showing, what amount of expenses this parent is showing, and the government GST department has issued a show cause notice to the listed company that please give me the complete reconciliation between these numbers and let me know where the GST has been short paid. So the taxation department or government has a different perspective. What about the lender? What about the lenders? The lenders has to see the different ratio like debt service coverage ratio, interest service coverage ratio, whether the company is earning proper profit, whether the company will be able to repay our debt in time, whether the company will be service the interest obligation in time, right? So friends, the objective of general purpose financial reporting is to provide some information on the basis of which user of the financial statement, the stakeholder can take prudent decisions. All agree with me? Okay. Now, second, this standard talks about, and you will find that this standard talks about the general things, not as specific things, right? For example, when you read in AS 10, it talks about a specific thing, events occurring after reporting date. When you read PP standard in AS 16, it talks about a specific thing, only about fixed assets. When you read intangible asset standard, it only talks about intangible asset, but this framework talks about the general things, right? Second, it talks about the qualitative characteristics of useful financial statement. Qualitative characteristics of useful financial statement. Characteristics of, I would say, financial statement, right? it is expected that financial statement should be useful. And friends, when you look at this qualitative characteristics of financial statement, this standard talks about two kind of characteristics, features. One is fundamental, means mandatory, fundamental characteristics, and second one is enhancing characteristics. Fundamental characteristics, fundamental features, and the second one is enhancing. Enhancing means recommendatory, fundamental means mandatory. What is the fundamental characteristics? The information in the financial statement should be relevant. For example, relevance, the rule of relevance. And faithful representation should be there. Faithful representation. Faithful representation should be there, right? Faithful representation should be there. What is meant by faithful representation? Means substance over form, right? The transaction has to be disclosed. The transaction has to be presented in such a manner for which it is intended to, and it can provide a relevant information to the user of the financial statement. Enhancing characteristics. Enhancing means recommendatory, right? Enhancing, which provides or which add beauty to the financial statement. For example, comparability, right? Comparability. The information should be comparable, right? Comparability. Consistency, right? Timeliness. The information has to be provided on a real time basis. And you have seen that for a listed company, the stock exchanges has given a timeline of 60 days from the close of the year end, right? For the publication of the financial statement. Okay. Third, financial statement and the reporting entity. This framework talks about what is meant by financial statements, right? You all are aware that what is meant by financial statement. What are the component of the financial statement? What are the component of the financial statement, Viraj and Namrata? What are the component of the financial statement? Yes, right, Rahul. Balance sheet, profit and loss, cash flow statement, statement of changes in equity, and notes to accounts. Very good, right? So this framework also defines financial statement, talks about financial statement, and it also talks about the reporting entity. Reporting entity, right? Who is the reporting entity? The entity which reports, the entity which prepares the financial statement is known as a reporting entity, right? Okay. Guys, are you clear so far? I can see the response only from one or two students. Yes, Namrata, you are right. You're right, Radhika. Yes. Reporting entity, for example, standalone financial statement, consolidated financial statement, right? Number 4. This standard also talks about the elements of financial statement and the interrelated relationship with the finance elements of the financial statement. What are the elements of the financial statement? I have covered this thing in Ind AS 1 as well. What is the element of the financial statements? Can anyone tell me what is the element of the financial statement? Panch Tattva. What are those 5 tattvas, 5 elements? What are those 5 tattvas? What are those 5 elements? वो 5 तत्व कौन से हैं फाइनेंशियल स्टेटमेंट के? Whatever we have discussed component, Radhika. Yes, you're right. 3 for balance sheet and 2 for profit and loss, right? Asset, liability, equity, not capital. Asset, liability, equity in balance sheet, and income and expenses in the profit and loss. Name any item. Name any item it will fall into these 5 elements. For example, the company has raised equity shares. So what is that? That is equity. What is the accounting entry? Cash account debit, bank account debit to equity, right? The company has incurred salary expense. The company has paid salary to one of its employee. What is that? Salary is an expense, and the cash which is going out is an asset which is going out, right? So name any item, it will fit into these 5 things: asset, liability, equity, income, and expenditure, right? After elements of financial statement, so number, it is not like that enhancing characteristic is not mandatory. It is also, I would say, in not that sense, but of course it is also to be complied with, right? First, fundamental characteristics means it is assumed, right? Enhancing characteristics means it has to be there, right? Like going concern. Going concern is a fundamental accounting assumption, right? But is it necessary that everyone has to prepare the financial statement on a going concern basis? Answer is no. If going concern is jeopardized, if going concern is impacted, in that case, it is not required to be prepared on a going concern basis, right? But if going concern has to be followed, it is not required to be written that, that the company is following a going concern, right? So in that sense, it is not like it is not mandatory. It has to be followed with, right? But in the degree, this fundamental characteristic comes before the enhancing characteristics. The information should be relevant. The information should be faithfully presented before this comparability, consistency, and timelines comes into the picture. Okay. Yes. Then, friends, this standard talks about recognition and derecognition. Recognition and derecognition. What is meant by recognition? When you read any asset-based standard, when you read any asset-based standard, after objective and scope, it starts with recognition. For example, when you read PPE standard, it starts with recognition that a PPE has to be recognized when there is a probability of future economic benefit flow to the entity and cost can be measured reliably. When you read intangible standard, it starts with an intangible asset has to be recognized when it meet the definition of an asset, right? Second, the future economic benefit is probable, the cost can be measured reliably. So friends, recognition means, and recognition of what? Recognition of the element of the financial statement into the financial statement. Recognition of an asset into the financial statement. Recognition of the liability into the financial statement. Recognition of equity into the financial statement. Recognizing the income, recognizing the expenses. For example, when you read 115, it says that revenue has to be measured and recognized when the entity has performed the performance obligation, when the entity has completed the service, rendered the service. Okay. So this is known as a recognition. And you can see that when you go to the particular standard, it talks about the recognition of the relevant item. But here, it talks about the recognition of asset, liability, equity, income, and expenses. So you must have understood that this framework is like a head of the family who is taking care of all the standards, who is taking care of all the branches of the family, right? So recognition means in asset-based standard, it is only talking about asset. In liability-based standard, it is only talking about liability. In income, it is income. In expense, it is expense. In equity, it is equity. But here, this framework talks about the recognition of all the element of the financial statement. What is meant by derecognition? Derecognition means removing the existing item in the financial statement, and derecognition is only for asset, liability, right, and equity. Because what you will derecognize, which has been recognized. So asset, liability, and equity will only having a closing balances. Income and expense will not have closing balances, right? And that is why, friends, as far as derecognition is concerned, you will find this derecognition principle only in asset-based standard, liability-based standard, and there is no equity-based standard. In financial instrument takes care about that. But so you will find this derecognition principle only in the asset, liability, and equity. Are you all agree with me? Are you all agree with me? Yeah. Are you all agree with me? Viraj is saying, sir, paper one final was having 6 marks question on same point. So that's what I have told you, Viraj, that from this standard, from this framework, you can expect a question of maximum 4 to 5 marks. So this time it could be 6 marks, but it will not be more than that. Okay. At times when someone is formulating any paper or drafting any paper, right? So looking into the weightage of the marks, looking into the question which he is asking, right? So the number could vary from 1 or 2 marks, but you can expect, right? Or you can give a weightage of 5 marks to this particular conceptual framework. Okay. In many attempts, even there was no any question which has been asked from the conceptual framework, right? But when you look at all the past papers, you will not find more than 6 to 7 marks question from this conceptual framework. Okay. But let me tell you in a different manner, this concept framework is, I would say, is the most easiest chapter. Why? More than 50% of the things you are already aware of, right? Already aware of. You have read in class 11, class 12, CA foundation, CA inter, and CA final as well. When you are reading with all these standards, because these standards are based out of this family, based out of this framework itself, right? Is that clear? Recognition and derecognition, this framework talks about and takes care of this thing also. Then if see the sequence. First, this framework covers general purpose financial reporting ka objective. What is the objective of the financial statement, general purpose financial statement? Then this framework covers what is the qualitative features of the financial statement. Then this framework has covered the financial statement, that what are the financial statement and who is reporting these financial statement. Then this framework has covered, and that it is framework. Okay. Because since last 8-9 years, when I'm teaching standards in AS, so I'm used to it, right? Because there are 39 standards and one framework. So in a complete year, we used to, deliberate hardly 2 or 3 times on this conceptual framework, but 100 or 200 times on the standards, right? Okay. So coming to the next part, next unit, next chapter, I would say we'll talk about the measurement, right? For example, when you go to the financial instrument, it talks about fair value, right? When you go to the PP, it talks about revaluation model, means fair value, or it talks about cost. When you go to the intangible asset, it talks about cost or fair value. When you go to the impairment related standard, it talks about the value in use. So friends, there are a lot of concepts in measurement like historical cost, fair value, present value of future cash flow, which is value in use, right? Current cost, which is replacement cost. So this framework also talks about the different measurement basis, right? Then the next part is, so you have recognized, you have measured, you have de-recognized. Then what is next? The next part is 7. Presentation and disclosure. How you will present those elements in the financial statement. What sort of disclosure you will made in the financial statement? Presentation and disclosure. And the last piece is concept of capital and capital maintenance, right? Probably the concept of capital is something which you all are aware of, but this capital maintenance could be a new concept for you, which I am going to discuss, right? Concept of capital and capital maintenance. Meaning of this conceptual framework for financial reporting. How is it different from the Indian accounting standard, right? So have you understood this part which I have discussed or deliberated in the last 30 minutes or 35 minutes? Have you well understood this or you haven't understood this so far? कि सर हो क्या रहा है, what is happening. Sri Ram is asking, sir, is there any question asked in May 2023 from this chapter? Yes, Sri Ram. So Viraj had just posted that in this May 2023. So question number 4B, right, which was talking about faithful representation, right? One of the qualitative characteristics of the financial information. So it was taking care of the faithful representation part, right? So one of the qualitative characteristics, faithful representation, what does it stands for? Okay, we'll discuss on that. Right, Viraj? Namrata, is that clear? Viraj, is that clear? I move forward. I did not got a chance to look at this May 2023 paper. Yes. Okay, let's move on. This is the entire agenda of conceptual framework for financial reporting, right? I would say this is a complete theoretical chapter. I would say this is not a very big chapter, right? Although these 8 different concepts are there. So I'll teach you this entire chapter with the Institute Financial Reporting material. Okay. Please let me know if Institute Financial Reporting material is visible. Is that visible? Is that visible, guys? Okay. Yeah. Chapter overview. We have discussed this, the agenda of the framework, right? Now let's go to introduction part. We have covered, and I've told you that this standard is helpful in standard setting bodies, right? Like ASB of ICAI, right? So this assists ICAI in formulation of Ind AS, right? It also, so basically it assists standard setters. It assists the consistent preparation, right? It assists preparer of the financial statement to develop consistent accounting policies when no Ind AS applies to a particular transaction or event. As I have told you that when you read Ind AS 8, it says that if there is no any specific standard on a particular accounting concept, then you have to follow a framework, right? This standard also talks about the consistent preparation when an Ind AS allows a choice of accounting policies, right? Like this standard, this framework says that the information should be comparable. And you tell me, for example, in a particular year, if a company is following a cost model and then company is following a revaluation model, in that case, the numbers will not be comparable, right? But Ind AS provides a policy choice. Okay, Ind AS gives you a choice. So then this framework comes into play and it says that the numbers should be comparable. It means you have to make it comparable. You have to provide the adequate disclosure in the notes to accounts, or you have to retrospectively restate your numbers. Okay. Then interpreting Ind AS, it also assists all parties, all user of the financial statement to understand Ind AS, interpretations of Ind AS, right? So this is how this framework helps in these things, right? Okay. So let's move on. Coming to the unit number 2, objective of general purpose financial reporting. I've discussed that what is the objective of general purpose financial reporting. The objective of general purpose financial reporting is to provide financial information, right, about the reporting entity, which is useful for existing and potential investors, right, lenders and other creditors in making decisions relating to providing resources to the entity. For example, if you are an investor, so it is important to look at whether you have to invest or you are not required to invest, right? If you are a lender, it is important to understand whether you need to provide additional financing to the entity or whether the interest and repayment of principal is at appropriate time or not. So these kind of decisions I have explained you in detail, that these kind of decisions will be taken by the different users of the financial statement or by different parties, okay, by different parties, right? In buying or selling or holding equity and debt instrument, providing or settling loans and other forms of credits, or exercising rights to vote on otherwise influence management action that affect the use of the entity's resources. Okay, right? Is that clear? Okay. So these are the objectives of financial state, general purpose financial reporting, which we all are aware of. Okay. Now let's move on. Limitations of general purpose financial reporting, sir. Whatever financial statement, for example, if I'm looking at a financial statement of Zomato, you must have heard about Zomato, Nykaa, Flipkart, Make My Trip, right? If I look at the financial statement of all these entities provide the information which is related to past only, right? For example, when you look at the financial statement of Zomato, you will get an information up to 31st March 2023, and you are sitting on 4th May 2023, right? So friends, in the financial statement, you will not be able to have information relating to the future, right? Relating to the changes in the political environment, related to the changes in the economic environment, the future expansion plan of the company, right? The future rollouts of the company. You will not be able to get the information about the future outlook of the company. Where you will get the information? You will get the information in the annual report, in the management discussion and analysis section, right? But only looking at the financial statement, which is general purpose financial reporting, you will not be able to understand, you will not be able to have a view about the future expansion or future outlook of the company, right? In that case, what happens? What happens? You will not be able to have a prudent decisions, right, about the future. So this is one of the limitations of general purpose financial reporting. That is why generally analysts, investors, what they used to do, apart from financial statement, they are referring the director's report, they are referring the corporate governance report, they are referring the management discussion and analysis report, they are referring the press release, they are referring the press release, okay, they are referring the media news about these companies, right? So they are collating all these information and they are reading this information in consistence or in agreement with all these items, right? So this is one of the limitation of general purpose financial reporting. For example, when you look at the financial statement, you will find that the company is into losses, but the valuation of the company is 1 lakh crore. You must have heard about the valuation of Byju's, right? Byju's is a loss-making company. They are incurring a losses worth thousands of crores, but they have a valuation worth lakhs of crores, right? So friends, if I talk about the financial valuation is different from the net worth or different from the data which the financial statements are showing, right? So this is one of the limitation of general purpose financial reporting, right? They are not providing the plan because this financial statement are for the past, right? The balance sheet as it, statement of profit and loss for the year ended, not ending or will be ending, for the year ended, right? But of course, the data provided by the financial statement, general purpose financial statement, is important to understand the performance of the company, trend of the past performance, the important notes to accounts, looking at the governance of the company. But this is of course one of the limitation of the general purpose financial statement as well, right? What are the information provided by general purpose financial reports? The general purpose financial reports provide kind of information. What are those? Financial position, right? So it provides the financial position, right? Okay. Financial position means it provides the situation of assets and liabilities, that what are the economic resources the company is having, what are the claims or obligation the company is having. In my conceptual framework, the assets has been represented by the economic resources, the liabilities have been represented by the claims, right, or obligation. It talks about the financial performance, that what are the financial performance of the company, and how you will find the financial performance. You will find the financial performance by looking at the profit and loss account. It also gives you the liquidity position. The liquidity position. How you will be able to understand the liquidity position? You will be able to understand the liquidity position by looking at the cash flows, right? For example, the company has a 50,000 crore of revenue, and the company has 30,000 crore of expenses. What is the profit? What is the profit in this case? What is the profit in this case? In this case, the profit is how much? 20,000 crores. And you must be saying, after looking at P&L, you must be saying, oh, this is a great company, 20,000 crore profit. I have to invest in this company, right? But let me give you some more information. The entire revenue is on a credit basis for a period of more than 1 year. The entire expenses has to be paid on immediate basis, right? So for example, this is the first year of the company. When you go to the cash flow statement, you will find that the company is having a negative cash from the operations. Why? The company has to pay taxes in cash, the company has to pay expenses, but the company does not getting any money out of it. So it means the company has to either use its own capital, which is a huge amount, or the company has to get the money from the lenders and the company has to invest in its operations. So probably if tomorrow these customers will have a default, or let's say the pandemic like COVID came in 2020 and no one was expected that one day this kind of pandemic will come and it will lock everyone in their home, in their house, right? So no one has predicted in their entire life. In my life of last 39 or 40 years, I have seen this pandemic first time, this kind of scary situation. So friends, for example, if tomorrow the pandemic will came and the majority of these customers defaulted, in that case, the company will be out of cash and the company will be in a great financial danger. So looking at the financial performance, looking at the balance sheet, you will find the balance sheet and cash is in P&L is doing a great job. But you will get the reality when you look at the cash flow statement, right? So friends, the financial reports provide the financial position, financial performance, your cash performance, and the changes not resulting from the financial performance. What is meant by this? This is meant by equity. Changes not resulting from financial performance. What is meant by changes not resulting from financial performance? For example, the company has earned no any profit, but the company has issued rights shares. The company has raised equity shares. What is the accounting entry? Bank account debit to equity share capital account. And whether this is from financial performance, the net assets have been increased. The company has come up with IPO and the net assets have been increased by 10,000 crores. Is it whether this 10,000 crore is it resulting to economic performance? Answer is no. The company has raised equity. This is a transaction with the equity holder. This is not a performance of the company. The company has not earned anything, right? Which means this equity movement. Okay. So the financial reports, the financial statement provide you the situation of assets and liabilities, the profitability, which is financial performance, which is your profit and loss, the cash flow statement, and the changes resulting from the changes resulting from the equity transaction. I mean to say the transaction with the equity shareholders, right? Is that clear? Is that clear? Namik, financial performance means how the company is performing, and this financial performance is reflected by the profit and loss account, right? Sriram, don't worry. I'll discuss this capital and capital maintenance concept. Okay. Okay. And what is meant by economic resources and what is meant by claims? Economic resources are represented by assets. The claims are represented by liabilities. This is all theory. I'm not reading this theory. If you want, you can read this theory, right? Let's come to the important part from which the question has also been asked. Qualitative characteristics of useful financial information, right? We have covered general purpose financial information. Now we are covering the qualitative characteristics of useful financial information. What is the qualitative characteristics of useful financial information? Friends, if the financial information has to be useful, right? First, the information should be relevant. Information should be relevant. And it has to be faithfully represented. Faithfully means it has to be religiously. It has to be appropriately represented. What it purports to represent. The usefulness of financial information is enhanced. See the word. The usefulness of the, first of all, it should be relevant in bold and faithfully represented. Namrata, please see here. The usefulness of financial information is enhanced. So it is talking about enhancing characteristics. If it is comparable, verifiable, timely, and understandable, right? Let's look at these two fundamental qualitative characteristics in more detail. So first of all, let's talk about the meaning of relevant and faithfully represented. What is meant by relevant and what is meant by faithfully represented? Friends, the information should be considered as a relevant financial information. The information should be considered as a relevant financial information if it provides a predictive value and confirmatory value. Either it provides a confirmatory value or it also provides a predictive value. Sir, what does it mean? First of all, the information should be relevant if it is faithfully and it should be faithfully represented. For example, revenue, right? What is meant by predictive value? First of all, let's understand what is meant by predictive value. For example, revenue. So looking at the revenue, let's say you are looking at the annual report of Reliance Industries, right? And you are looking at the pattern, trend of the revenue. And you have seen the trend that, for the year 17, 18, 19, 20, 21, 22, let's say, okay? You have seen the trend that the company is growing by 5% every year. The company is growing by 5% every year. Right? And you can use those input. You can use this input to predict what could be the forecasted cash flow, what could be the forecasted top line, forecasted profit of this company for the next year, right? And this is how the analysts are doing. So how can you saying that the company Zomato who is into losses, Byju's who is into losses, right? Nika, let's say, which is into losses, let's say, and so how do you say that these companies are making a huge profit? These companies are having a huge valuations? Because after processing some inputs from the financial statement, you are forecasting that what could be the future of this company, and according to the future of this company you are applying this valuation models and you are identifying the financial value, the valuation of this company, right? So the financial information with predictive value or confirmatory value or both, right? If the financial information is with the predictive value or confirmatory value, it is said that it is giving a relevant information. The information is relevant, right? So basically, sir, how this information could be relevant? The information could be relevant if it gives you a proper inputs to predict the future. For example, the profit and loss, it always start with revenue, other income, expenses, profit before tax, tax expense, profit after tax. In the balance sheet, it start with asset, then equity, then liability. So consistently you are getting a information, and according to the information you are making a trend, right? And according to the trend you are expecting the future. This is how you are doing in your audit also. Let me tell you, have you done the ledger scrutiny? Have you done the ledger scrutiny in your audit days? Friends, how this ledger scrutiny is going on and how the people are analyzing the financial statement, let me tell you, and how I do. Basically, when I'm looking at an expense, so I'm looking at an expense, that what is the trend of my expense. If it is out of trend, then I used to ask questions. For example, yesterday I was asking with my team member that, see, our appraisal are happening in the month of April, right? So in the month of April, the salary expense goes up. But after April until March, it month on month, it always will remain consistent, right? For example, if in the month of April, the salary expense is 100 crores, so I can predict that the next month it will also be 100 crores. Until and unless some major restructuring will happen in the company, until and unless, right? So from the past information, past trend, I am predicting a value in the future. So in the next month, when I will found 110 crores, I'll raise this alarm with my team member that why this is 110 crores. This number should be consistent. Whatever I have predicted, this should be consistent. This should be confirmed, right? And when my team member will deep dive into the ledger of that salary, he will find that someone has put a wrong expenses in this code, right? In this ledger code. So friends, having a relevant financial information, having a correct financial information will help you in predicting the future forecast. And this is how the analysts are doing, right? And they're raising questions. And they're raising questions when the predictions which they have made and the reality which has come, if it has had a lot of variations, then they raise a lot of questions. And today I'm telling you, when the companies are coming with the results, go to the BSC or NSC website and see which company is coming with the results, right? In the next 3 or 4 days. And just go to the CNBC and see, after the results, they have performed very well. Still, their share prices has gone down, right? So in just, I would say 7 to 8 years back, I was having a myth that if a company is earning a profit, then share price should go up. But this is not like. Why? Why, in spite of the fact the company is earning a profit in the quarter, still the share price has gone down? Why? Because the prediction which the analyst has done, the analyst has come out with the reports and says that the company will earn a profit of 10% in this quarter, but the company has earned only a profit of 4%. So the reality is much lesser than the expectation, right? And this is how the share price goes down. So friends, the framework says that the financial information is having a predictive value if it can be used as an input to process the future outcomes, to predict the future outcomes, right? And it has a confirmatory value. It provides a feedback about the previous evaluations, right? For example, what you have expected and what reality has become. So friends, in this case, you can say that the information becomes relevant, right? It should be relevant so that you can make an opinion, you make an assumption on the basis of those information. Example number 1, revenue information for the current year, which can be used as the basis for predicting revenues for the future years, can also be compared with the revenue predictions for the current year that were made in past years, right? The result of those comparison can help a user to correct and improve the processes that were used to make those previous predictions. Okay. And friends, The characteristics of relevance also includes the concept of materiality. And what is the concept of materiality? And I'll give you a classic example here. Right. So for the telecom companies, one of the announcement from Supreme Court has come in the matter of AGR, adjusted gross revenue, AGR. In 2019-20, and to be precise, in October 2019. October 2019, yes. So the Supreme Court has come up with an announcement, and due to this announcement, there was a liability on the Vodafone Idea to the tune of close to 60,000 crores and Bharti Airtel to the tune of 30,000 crores, right? Now what happened? Due to this announcement, Vodafone Idea has reported a highest ever loss in Asian history of 60,000 crores. The number is big, the number is material, and they have shown this item as an exceptional item, right? So friends, now you tell me, if this item has not been shown as a material or as an exceptional item, and this item would have been clubbed with the other expenses, whether that information will be relevant for a user of the financial statement, and no disclosure should be given for that, whether it should be relevant, answer is no. For example, I am a shareholder of Vodafone Idea. So how I am predicting, how I am making an opinion? So the company has not disclosed this item. Let's say the company has disclosed. I am giving a hypothetical situation. The company, there was an AGR announcement by Supreme Court, and this is a one-time problem. This is a one-time hit. It doesn't mean that every quarter the 60,000 crore will come, right? So let's say I am a shareholder of Vodafone Idea. When I was looking at Q2 results of financial year 19-20, I'm looking at, oh, the other expenses have substantially gone up by 60,000 crores. My God. It means, and due to this other expenses, the company has incurred a loss of close to 60,000 crores. Oh, it means every quarter the company will have a loss of 60,000 crores. I am just giving an opinion in my mind. Okay. It means in a quarter, in an year, the company will have a loss of close to 2.4 lakh crore. My God, I should not invest in this company. I should immediately sell out my entire portfolio. Right? And I've started spreading rumors about this company. Viraj is a shareholder of this company again. And let's say Viraj got a financial statement where Vodafone Idea has shown this item as an exceptional item. And this company has also given a disclosure of this. When Viraj is looking at the financial statement, or I would say the results which has been filed with stock exchange, he is looking at results and he is saying, oh, this was due to the outcome of Supreme Court in a very old matter, which was 15 years old matter. And this was only a result of the Supreme Court outcome. So this is not something which is happening again and again, right? And when he was reading the notes to accounts, and when he was reading, and when he was looking at the exceptional item in the profit and loss, he is making an opinion. Okay, the running loss of this company or the running profit of this company is, let's say, 2,000 crores. But the exceptional material item, due to this material outcome, judgment, the loss is 60,000 crores. Okay, so it means in the full year, if the company is making a profit of 2,000 crore, so we will see in the full year, we will see 8,000 crore normal profit, 60,000 crore one-time hit. So we will have a 52,000 crore of loss when we end the year. So I am just making a prediction for the entire earnings of a year. Okay. And I am also saying that this 60,000 crore is a one-time hit. It is an exceptional item. It is a material item, and it is a non-recurring item. Okay. So this is how I am putting these information. I am getting this information, and I am helping myself in framing a future opinion. Are you getting this? So friends, the information should be relevant if it gives you a complete basis for making a future forecast, right? Okay. And the information and the relevance means the material concept should be there. The materiality should not be avoided, right? and the material item has to be shown separately. And friends, if you see this materiality, this concept is there in Ind AS 1 and Ind AS 8 also. If you remember and able to recall the concept of Ind AS 1 and Ind AS 8 relating to the material prior period errors. If the prior period error which is material, in that case, the numbers is required to be retrospectively restated and the third balance sheet is required to be given. Do you able to remember? But if it is not material, then these things are not required to be done, right? I hope it is clear to all of you. I hope it is clear to all of you guys. Yeah. Namrata is asking how financial performance is linked with comprehensive income. So Namrata, comprehensive income means your statement of P&L is including comprehensive income. So the word written here is comprehensive income, but ideally it should be statement of profit and loss, right? So comprehensive income includes your profit and loss plus other comprehensive income. When you see the profit and loss, you will find profit after tax plus other comprehensive income is equal to total comprehensive income. So it is talking about that only. Guys, have you understood the meaning of relevance? I hope you have understood the meaning of relevance. I have spoke about this thing in detail. Coming to the faithful representation. It says that the substance of the transaction should be reflected faithfully. And let me give you an example. Let me give you an example. Sale and leaseback transaction. Have you heard about sale and leaseback transaction? The seller will become the lessee, right? The seller will become the lessee and buyer will become the lessor. So for example, I have entered into a contract with Namrata, right? So this is my property. I'm using this property, but I'm in urgent need of money. So I have entered into a transaction with Namrata and I have told Namrata, see Namrata, I need 20 lakh rupees. So Namrata said, okay. But how can I give you, sir, how can I give you 20 lakh rupees? I don't know you, right? Just having few lectures from you on a virtual mode doesn't mean that I'll give you 20 lakh rupees. So I told Namrata, okay, I'll give you my property. I'll sell you my property. Okay. So Namrata said, okay, sir, but why I should buy your property? So I told Namrata, don't buy my property. Give me 20 lakh rupees. Okay. And just enter into another agreement. After 3 years, I will buy this property again. So I am selling you this property on 20 lakh rupees. And after 5 years, I will buy this property at 30 lakh rupees. So how this transaction has been framed? I was in a need of money. I got a money. Namrata got a security in terms of the paper of property. I got a comfort in terms of when I was using this property for running my office. Still, I am in the possession of this office. But what I have done, I have entered into an agreement with Namrata, lease agreement, where I am in the possession of this property and I am giving a lease rental to Namrata, right? So in the next 3 or 4 years or 5 years, I'll give her 10 lakh rupees as a lease rental, right? And after this point of time, I'll again buy this property. So if you will see the substance of, if you will see the form of this transaction, you will find that, oh, first, this is a sale and purchase transaction. Second, this is a lease transaction. But when you go to the substance of this transaction, you will find the substance is not lease. The substance is the financing arrangement, right? The substance is the financing arrangement. There was just an arrangement which has been made. And due to this arrangement, the person who was having a possession of this property is still in the possession of this property, right? And the person who was not having property is still not having property. And there was a backup arrangement for getting this property back after a few period of time. So going by the substance, it is a financing arrangement. Going by the form, it is a leasing and sale and purchase arrangement. So friends, you must be wondering, at many point of time in the standards, in Ind AS 116 leases standard, there is a concept of sale and leaseback transaction. What is that concept? That concept is nothing, it's a substance over form. Coming to the Ind AS 109 standard, Ind AS 109 says that preference share capital The word is capital, but is it a capital? In our accounting standard days, we were showing this preference share capital as a part of the equity share capital. But is it a capital? Answer is no. In India, irredeemable preference share is not allowed. Redeemable preference share is allowed. So redeemable means these preference share will always enjoy the right before equity shareholder in case of liquidation or winding up, right? So if it is a liability, so going by the substance, it is not a capital, it is a liability, right? So equity shareholder is an equity, it is a capital, it is a residual interest, but preference share capital is not a residual interest. So in Ind AS and IFRS, this preference share capital has been shown as a liability, not as a equity, right? This is one of the big change from AS to Ind AS. Friends, third example I'll give you. So see, I have given you the example of substance over form from Ind AS 116, Ind AS 109. These are two different standards. Now let's come to the example of Ind AS 110, which talks about consolidated financial statement. It says that the concept of de facto control. For example, Mr. Ambani, 1,000 shares, and we are least bothered about the affairs of the Reliance Industries. We are not conducting any AGM. We are not visiting the office, right? Because hardly we have invested 10,000, 20,000, 40,000, 50,000 rupees, right? We are not shouting on any decisions. So if you look at the substance, if you will look at the form, you will say that, sir, Mr. Ambani is having less than 50% share. So Mr. Ambani is not controlling Reliance. But in Ind AS and IFRS, going by the substance over form concept, in Ind AS and IFRS, there is a concept of substance over form. And when you go by the substance, Mr. Ambani is controlling Reliance. How come it is controlling Reliance? He is controlling Reliance because he is the largest shareholder of Reliance, right? And the remaining shares are widely dispersed, widely distributed among the various shareholders who are not even attending the AGM of Reliance. So friends, this is a concept of de facto control. And let me tell you, I don't know whether you have covered Ind AS 110 or not, but when you read Ind AS 110, this is a new concept in Indian accounting standard, which talks about going by the substance, Mr. Ambani will consolidate Reliance Industries Limited, right? Have you understood? So friends, I have told you 116, 109, 110, but how this concept is coming from? So these concepts which have been developed in these different standards. So these are on the basis of an underlying principle, which is substance over form. Is that clear? Is that clear? That is why the concept in the conceptual framework is the element of the financial statement or whatever has been given in the financial statement. When I'm talking about financial statement, I'm talking right from the balance sheet till notes to accounts. So every item has to be faithfully represented. It means it provides the substance of the situation and condition to which it is supposed to, right? In my first case, the substance was not to sell the property. The substance was not to get the property on lease. The substance was to get the money, get the funds from Namrata on an interest, right? If she would have agreed to give me this 20 lakh rupees on a normal interest basis, probably I would not have entered into these kind of arrangement with her, right? But she was needing a security and she was needing a title. That is why I have entered into this kind of arrangement, right? And friends, for complying with a faithful representation, the information should be complete. It should be complete, right? It should be complete, first of all, complete in all aspect, right? It should be neutral. The information should be neutral. Neutral means it should not be biased. It should not be biased. Means it should not be well emphasized. It should not be manipulated. For example, if you are reflecting revenue from operations, right? And last year the revenue was 10,000 crore. This time the revenue is 10,500 crores. It is just 5% up. But you are so emphasizing the revenue that the shareholders are thinking after reading that thing, they are thinking that, oh, the company has done a great job, right? But the point is, the company has not done a great job. It was just due to the increase in the prices. Are you getting me? So either the information should not be manipulated, it should not be hugely emphasized, de-emphasized, right? Or it should not be biased. Okay. The information should be free from errors, right? If the information was having error, probably it should not be faithfully represented. Is that clear? Is that clear? For example, sir, can you give me an example of faithful representation? For example, if you are depreciating your fixed assets, you are depreciating over a useful life of the fixed asset. You are depreciating over the useful life of the fixed asset. And for depreciating on useful life, you have to estimate the useful life, right? You have to estimate the useful life. So this use of reasonable estimates are essential part of the preparation of financial statement. So you have to ensure that the information which you are gathering is complete, it should be neutral, and it should be free from error, so that you will come out with the proper assumptions, right? We have discussed that what are the fundamental qualitative characteristics. It should be, the information should be relevant and faithfully presented. Now, what should be the enhancing qualitative characteristics? What should be the enhancing qualitative characteristics? Comparability. The information should be comparable, right? The information should be comparable from one period to another. For example, if you're changing an accounting policy, you are required to restate your comparatives. You have to give the third balance sheet. For example, if there is a prior period error, you have to, in that case, if it is material, right? So materiality is very important. If the prior period error is material, you have to restate your comparative and you have to give the third balance sheet as well, right? So that the information should be apple to apple, it should be comparable. Verifiability. Verifiability means the information can be verified, right? The information can be verified. Okay. If a shareholder or a user of the financial statement wants to verify the information, he or she or it can be able to verify that information either from the notes to accounts or from the other aspects of the company. For example, information about the shareholders. The company has given the information about the promoters who are having the shareholding in the company, or the company is giving the information of the major shareholder who are having more than 5% of the share capital, right? Friend, if I have to verify the information, I'll go to ROC and can verify, or I'll go to the website and I'll go to the check the public documents, right? I can do that. The list of directors, share capital. So the information should be verified within the financial statement from different sources or from the outside the financial statement. So the information should be free from error. It should not be manipulated and should be correct information. Understandability, right? So first of all, the items in the financial statement should be clearly classified and it should be clearly presented, right? So that it makes it understandable. And let me give you an example. For example, the company has sold fixed assets and the company got a profit on sale of fixed assets. The company was having a, let's say, top line of 1000 crores. The profit on sale of fixed asset is 100 crores. The total top line becomes 1100 crores and the company is having an expenses of 900 crores. What is your profit before tax? 200 crores, right? It is 200 crores, right? 1100 is your total revenue including other income. 900 is expenses. Profit before tax is 200 crores. Friends, let's say instead of profit on sale of property, plant and equipment showing in other income, the company has netted off it from other expenses, right? The company has netted off from other expenses. In this case, your top line total revenue becomes 1000 crores. Your expenses become 800 crores, right? And your profit will still 200 crores. There is no change in profit. But due to change in classification, the understandability criteria of financial statement has lost its sanctity, right? Why? Because as a user of the financial statement, I have not been informed that yes, 100 crore was on account of sale of property, plant and equipment, right? So one could one of the important information on the basis of which I was making a decision. This could be misunderstood, or this could be hidden from the user of the financial statement. This could be hide from the user of the financial statement. So friends, the enhancing qualitative characteristics is the information should be comparable, it should be verifiable, it has to be provided on time. Tell me, if the financial statement of 31st March 22 is presented today, whether it makes any sense. Answer is no. You are getting a highly stale information. You are getting a information about the past after 1 year. So if the information has not been provided on time, it does not impact the it does not result in impacting any decision making capacity. For the CA final result, the attempt is always happening in May and November, right? The May result will come in July. If the May result will come in October, whether it makes any sense, answer is no. Because unfortunately, if the students who has not got passed, he will not be able to take a decision in the month of October that after 14 or 15 days whether he will be able to appear in the exam or not, because he does not get a sufficient time for the studies, right? So friends, that is why if the information will not be provided in time, it does not make any sense. So what are the enhanced qualitative characteristics? Comparability, verifiability, timeliness, and understandability are the important qualitative characteristics which enhance the financial information, right? Financial statement and the reporting entity. Guys, I hope whatever I have told you, 50% I can assume you are already aware of, because you have read so many standards so far, right? Is that clear? Viraj is asking, sir, is faithful representation and true and fair view of state of affairs of the balance sheet are similar? So Viraj, faithful representation is more towards a particular element or item, right? Whether that item has been faithfully represented or not. True and fair view is talking about the entire financial statement, right? Whether the entire financial statement are reflecting true and fair view or not. For example, let me tell you, Reliance Industries Limited is a big company. They have shown 5 crore rupees of expenses into a different line item. If I'm talking about a particular line item, it is not faithfully represented. But if I'm talking about at a financial statement level, when you as an auditor is giving an opinion, the financial statement are reflecting true and fair view. So can you say that it is not reflecting true and fair view? No. 30,000 crore bottom line, lakhs of crores top line, lakhs of crores of balance sheet. The figures is presented in rounded off in crores. This 5 crore will not impact in any manner to the Reliance Industries Limited, right? So talking about the state of affairs, it could be true and fair view. It could be a financial statement could be true and fair view, but talking about a particular item and talking about a concept of faithful representation, probably a particular item has not been faithfully represented. But yes, you can say that it is a subset of true and fair view. Okay, is that clear, Viraj? Now coming to the financial statements. What are the financial statements? Do I need to talk about this? What are the financial statements? And you have read this in Ind AS 1. If you see in Ind AS 1, you have already read what are the component of the financial statement: financing activity and operating activities, then notes to accounts, right? In case of change in accounting policy or correction of material prior period errors, then the comparative should be restated and the third balance sheet, which is opening of the comparative, should be presented. You remember I have shown you the ONGC financial statement. You remember that? Friends, I'm not talking more about this financial statement because we have already covered in this one presentation of financial statement. We all are aware about the financial statement, right? Coming to the reporting period, what is meant by reporting period? Reporting period, see, financial statement are always for a particular period. For example, for a quarter. Your condensed financial statement is for the quarter, for the half year, for the 9 months ended, or when you see the financial statement, balance sheet as at 31st March 22, balance sheet statement of profit and loss for the year ended 31st March 22, right? Notes to accounts as at end for the year ended 31st March 22. So reporting period is a period for which you are presenting the reports for the entire transactions. You are presenting the outcome of the transactions in the form of a financial statement. For example, how much you have earned during that period, how much you have expensed in that period, how much profit you have earned, what is the balance sheet size, what is the balance sheet position at the end of the year, right? So you understand, first you put the journal entries, then it comes into the ledger, then it comes to the trial balance, and from the trial balance your financial statement has to be presented, right? Is that clear? So coming to the perspective adopted in the financial statement, the financial statement has to be presented from the management perspective. I mean to say from the company's perspective. Financial statement provide information about transaction and other events viewed from the perspective of the reporting entity as a whole, not from the perspective of any particular group of entities, existing or potential investor, lender, or other creditors. What does it mean? For example, the company is a debt company, and the majority and the major line item in the balance sheet, the major amount in the balance sheet, the highest amount in the balance sheet pertains to the borrowings. Okay. In this case, the company will not say that, oh, I have to influence or I have to make my lenders happy. So what I'll do, instead of taking the borrowing as per the schedule 3, so presenting the borrowing as per schedule 3, what I'll do, I'll present my first line item as a borrowing in the balance sheet. So when you're thinking about this thing, you are thinking from the lender perspective. You're not thinking from the company as a whole perspective. Or you are saying that in my entire financial statement, doesn't matter whether I'll give the actuarial disclosure or not, whether I'll give the related party disclosure or not, contingent liability disclosure or not, I have to give all the disclosure relating to the borrowings. मैं क्या करूंगा, पूरा का पूरा लोन एग्रीमेंट छाप दूंगा अपने नोट्स टू अकाउंट्स. Guys, is that okay? It means you are preparing the financial statement taking into the perspective of the lender. Okay, what my lender requires, what ratios he looks. You are not preparing the financial statement from the perspective of the company as a whole. You're not giving a tabajju or you're not giving a weightage to the related party transaction, contingent liability, actuarial disclosure, and other items of the companies, right? You are only giving a weightage to the borrowings. So friends, it's a very basic thing that whenever you prepare financial statement, it should be neutral and it has to be presented as per the generally accepted accounting principles, considering the framework, considering the Ind AS, considering the Companies Act provisions, right? Going concern assumption. It is a fundamental accounting assumption that your business will run for foreseeable future, means within 1 year from the reporting date, right? So it is a fundamental accounting assumption that your business will be run in the will run on going concern in the foreseeable future, right? Are you able to understand whatever I'm telling you? So I'm using a lot of examples. I'm referring standard also, so that you will be able to understand, oh, different standard, but the basic fundamental is same. And how this basic fundamental is same? Because all the standard have been drafted using this framework. Friends, I hope you guys are able to understand this thing. Friends, I hope you are able to understand this thing. Yes, Namrata, you are right. It is not a general purpose financial statement. That is why the financial statement should be from the perspective of the company. Reporting entity. What could be a reporting entity? A reporting entity is an entity which is required or chooses to prepare financial statement. Right? For example, a listed company has to prepare financial statement on a quarterly basis. It is required. But if an unlisted company chooses to prepare financial statement on a quarterly basis and want to publish on the website, again, it becomes a reporting entity. Whether it is required, answer is no, but it chooses. Okay. A reporting entity can be a single entity or a portion of an entity or can comprise more than one entity. A reporting entity is not necessarily a legal entity. Sir, तो क्या illegal entity होगी? Illegal नहीं होगी. It is not illegal. It is not legal. Okay. So friends, we understood that who is a reporting entity, who reports the financial statement, who prepare the financial statement. A reporting entity can be a single entity. For example, Reliance Industries Limited, they are preparing a separate financial statement. They are preparing a standalone financial statement as per Ind AS 27, as per Ind AS 1. So this is known as a single entity, right? Single financial, standalone financial statement. Or Reliance has a lot of branches across India or across the world, segment branches. And these branches are also preparing their financial statement, right? So that Mr. Ambani got a clear cut view that which segment is getting good profit. So when the portion of an entity is preparing a financial statement, it will also become a reporting entity, not from the perspective of that the information has been reported to outside world, but also it could be a reporting entity. Or it can comprise more than one entity. When you go to Reliance notes to accounts, you will find 10 pages scattering over the related party list. They have a lot of subsidiary, joint venture, associate. So in addition to separate financial statement standalone, Reliance is also preparing consolidated financial statement. So this consolidated financial statement is a group financial statement where the Reliance Industries plus all the subsidiary, JV and associates are also covered. Is it a legal entity? Reliance Industries is a legal entity, but whether this group is a legal entity, answer is no. क्या ग्रुप का कोई पेन नंबर होता है क्या? क्या ग्रुप का कोई सिन नंबर होता है? रिलायंस का तो पेन नंबर और सिन नंबर है, बट ग्रुप का कोई सिन नंबर या पेन नंबर नहीं होता, राइट? It is a family. It is a family put together. Reliance Industries plus subsidiary plus JV plus associate. So that is why it is not a legal entity, but Reliance is also presenting group financial statement, consolidated financial statement, right? So in this case, this group is also known as a reporting entity, right? A reporting entity could be an individual entity. It could be a consolidated entity. It could be a portion of an entity. Is that clear? This is what we have already understood and we have already read. Is that clear, guys? Let me know if you have any question. Namrata is asking what is difference between illegal and not legal. Namrata, I have given you an example. Whether Reliance Group is illegal, when the group is presenting the financial statement, is it illegal? It is not legal entity. Not legal entity का मतलब उसका कोई सिन नंबर नहीं है, उसका कोई पेन नंबर नहीं है, ग्रुप का. इंडिविजुअल एंटिटीज का है, ग्रुप का नहीं है, राइट? सो इट इज नॉट अ लीगल एंटिटी. Like proprietorship is a legal entity, partnership is a legal entity, company is a legal entity, but group कोई legal entity है क्या? And illegal you understand, which is not permitted by law. The group financial statement is permitted by law. The group is permitted by law, right? So friends, it's 8:34 now. Let's have a 2-minute break and we will start at 8:44. Friends, just one input from my side, how to write examination. For example, the question came on faithful representation as a qualitative characteristics, right? Or let's say in the worst case scenario, I would say there would be a 10 marks question which asked about your, let's say, what is the financial statement as per the conceptual framework, and who is the reporting entity, and state the qualitative characteristics of the financial statement, right? So it would be great if you will read, if you will write the answer from your memory as well as from your understanding, and I'll tell you how to write that answer. What are the financial statement as per conceptual framework in Ind AS? So you have to write the financial statement includes balance sheet, right? Statement of profit and loss, which includes other comprehensive income, statement of changes in equity, notes to account, statement of cash flows, and notes to account. So I want you to brief just 2 or 3 lines or 1 or 2 lines on all these component of financial statement, and you need to write also that even in as per Ind AS 1 as well, if there is a change in accounting policy or correction of prior period error, the comparative number needs to be restated, and the third balance sheet, which is opening of the comparative, needs to be presented, right? This is how you have defined this entire financial statement. And then who is the reporting entity? Of course, you need to write reporting entity is an entity which prepare the financial statement, okay? And a reporting entity could be a standalone, could be a single entity, be a portion of the entity, or could be a group of entity. Then you can give an example. For example, X Limited is preparing its standalone financial statement. This is a single entity. X Limited is having a 5 branches in Ludhiana, Srinagar, Jammu Kashmir, Jalandhar, right, and Delhi. These branches are preparing financial statement. This is a portion of the entity. And X Limited is having 2 subsidiaries, and X Limited is preparing consolidated financial statement. This is a financial statement group entity, right? This is how you have given your answer with the help of examples, right? Second, coming to the qualitative characteristics, you need to say there are 2 kind of qualitative characteristics as per the framework. One is fundamental characteristics. The second one is enhancing characteristics. Then in fundamental characteristics, you need to say the information should be relevant, right? So the financial information should be relevant, right? It should be material, and it should be faithfully represented. When you explain faithfully represented, one thing should be in there in your mind, which is substance over form, right? And when you appear in your exam, you have covered all the Indian accounting standard. Then remember the examples of substance over form in Ind AS. Like I have given you an example of sale and leaseback transaction in Ind AS 116, preference share capital in Ind AS 109, de facto control in Ind AS 110. So put these examples there, right? And then explain faithful representation. Then coming to the enhanced characteristics, you need to say that for faithful representation, you need to again say that the information should be complete, neutral, free from error. And the enhanced characteristics, you need to say that the information should be comparable, verifiable, understandable, and it has to be provided in time. So have you understood how you have to answer these questions? Yeah. Have you understood how you need to answer these questions? And of course, it should be on the basis of the weightage, right? If it is, let's say, 4 marks question, your theory should be limited. Is that clear, guys? Is that clear? Viraj, Sriram, I hope it is clear to all of you. Okay, thanks, Rohan. Great, great, Radhika. Thanks for this feedback. Yeah, coming to the element of the financial statement, guys. Element of the financial statement we have discussed. There are 3 elements into the balance sheet and the 2 elements to the P&L. Asset, liability, equity, income, and expense. Asset means the economic resources of the entity, and liability means claims against the entity, right? And the framework says that there is a link between all these elements. First of all, let's discuss the definition of these elements. What is an asset? Asset is the economic resources. What is a liability or equity? It is a claim, right? Like I, as a shareholder, has invested the money. I am expecting dividend. The lender is expecting interest and the repayment of debt, right? So the entire concept has been divided into three parts: economic resources, and changes in economic resources and claim, right? Other changes in economic resources and claim. If there are economic resources, this is known as an asset. If there are claims, this is known as a liability or equity. If there is a changes in economic resources and claims, means there is a increase or decrease in assets or increase or decrease in liability, but which represent financial performance, then it will come under income and expenses. But if there are other changes in economic resources or claim, but it is not showing a financial performance, for example, right issue, bonus issue, buyback of shares, distribution of dividend, then it is not an income or expense, right? Framework says that the entire these elements are interrelated. Example, paying a salary. What is the accounting entry if you will pay a salary? If you will pay a salary, what is the accounting entry? Salary expense account debit to bank account or to cash account. You can see that salary expense is an expense and claims. So how there is changes in economic resources? Your bank account, your bank balance or cash balance is going down. Your asset is reducing and your expense is coming. You can see this interrelation. When your asset is decreasing, your expense is increasing or your expense comes into picture. Right. Revenue. What is the accounting entry of revenue? The company has sold goods. Cash account debit to revenue account. So there is a changes in economic resources and claims. Cash account debit. So your asset is increasing and your income exists. When your asset is increasing, your income exists, right? So this is interrelated. Revenue is a P&L item. Cash is a balance sheet item. So cash is an asset. Revenue is an income. So framework says that these all things are interrelated, right? Now let's discuss the definition of asset, liability, income, expense, and equity. What is an asset definition? A present economic resource. A present economic resource controlled by the entity as a result of the past events. Controlled by the entity as a result of past events. The company has acquired a machinery. Machinery is a present economic resource. That machinery is controlled by the entity. How come it controlled by the entity? Because the entity has paid for it. The entity has paid a money, a consideration for acquisition of machinery. So this is a present economic resource controlled by the entity as a result of past events, right? An economic resource is a right that has the potential to produce economic benefit. That has the potential to produce economic benefit. This machinery is an asset. This is an economic resource. And this economic resource is a right. There is a right of the company which has a potential to produce economic benefit. When I'm saying produce economic benefit, I don't want to say only goods. For example, this machinery is there. Of course, machinery will produce goods. But if a company has sold goods on credit, what will the accounting entry? Debtors account debit to revenue account. What is a debtor? Debtor is an asset. It is an economic resource. It is an economic resource. And this economic resource is a right. So the company has a right to demand the money from the debtors. To demand the money from the debtors, right? So an economic resource is a right which has a potential to produce economic benefit. Means this right, I'm not talking about my debtor will earn money. I'm talking about my right because I have sold goods on credit, and this right has a potential to get me the economic benefit because my debtor will give me the money. Okay, if my debtor will not give me the money, then of course I'll impair. I will make a provision of it. But the point is whether it is an asset. Answer is yes, it is an asset. Right. This right could have a counterparty as well. This right may not have a counterparty. For example, in case of a debtor, there is a counterparty. So when you read the financial asset definition in financial instrument standard, you will find that the definition is a financial asset is an asset when there is a contractual right to receive cash or another financial asset which may be a financial liability for another entity, financial liability or equity for another entity. So in case of a loan taken, loan given, right? Selling goods. So there may be a counterparty, but in case of PP, I have purchased PP, now it is mine. I'm not required to pay to anybody. I have already paid. So in this case, there is no any counterparty, right? So this right may have a counterparty, may not have a counterparty. This economic resource may have a counterparty, may not have a counterparty, right? अब पीपी आप ये थोड़ी बोलते हो मुझे इससे लेना है, बट डेटर्स के लिए तो बोलते हो ना मुझे इससे पैसा लेना है, राइट? बिकॉज डेटर्स में काउंटर पार्टी है, पीपी में काउंटर पार्टी नहीं है. बट दिस both of these item is economic resource. It is a right which has the potential to produce economic benefit, right? And when it says controlled by the entity, what does it mean? Controlled by the entity. Controlled by the entity means the entity has a right to access the future economic benefit. The entity has a right to restrict others to use this item to get the benefit. For example, the company has purchased a building. If the company has purchased a building, the company will have a control over it. So control relating to the full usage. If the company wants to sell this building, the company can sell this building. The company wants to lease, it can lease out, right? The company wants to mortgage, it can mortgage. The company wants to pledge, it can pledge. The company wants to donate, it can donate. So whatever the company wants to do, it can do. And as well as the company can stop others. The company can stop others from using this asset. For example, if this asset belongs to company and I want to go into that building, the company can stop me. The official of the company can restrict me. No, you cannot enter into this building because this building is mine. Are you getting me? So friends, if you will see the definition in Ind AS 38, it says that intangible asset has to be meet the definition of an asset. And when you go to the definition, it talks about control. And when it talks about control, it talks about restricting the access from others. For example, if Bharti Airtel is getting a 5G license into a particular territory, in that case, the other operators cannot use that license, right? So if someone got the services for operating in that territory, he will only operate in that territory and he will stop others from using that territory. In FMCG companies, they are distributing the franchises, right? Dealership, distributorship. So if ITC has given a distributorship of Ashirwad Atta into a Jamnagar area to a particular person, probably this person will stop others, right? Or ITC will stop that person. You cannot operate in that area, right? Is that clear? The definition of asset is clear, I believe, to all of you. Coming to the liability. Now, what is a liability? Liability is a claim. It's a present obligation. Liability is a present obligation, right? A present obligation of the entity to transfer an economic resources as a result of past event. For example, trade payable. Is it a present obligation? Answer is yes. What is the present obligation? To transfer an economic resource. When you settle the liability, either you have to pay cash or you have to pay some other form of cash, other form of asset. Why? As a result of past event, because in the past you have taken, availed some service, you have purchased some goods, and you have purchased these goods on credit, right? So due to some past event, there is a present obligation to transfer some resources. Radhika is saying, sir, contingent liability. Radhika, contingent liability is not per se a liability which has to be recognized in the financial statement. It has to be disclosed. Why? Because contingent liability may not be a present obligation. It will confirm upon the future outcome. It will confirm on the happening or non-happening of some future events, right? Provision for warranty. Yes, it could be a liability. Why? Because you have sold goods on warranty. So due to the past event, if the customer will come to replace that product, you have to. To repair that product, you have to. So this past events, due to the past events, there is a liability. Okay. Is that clear? So what is a liability? It's a present obligation arising out of past events, right? Changes in then your changes in economic resources. Very beautiful definition, I would say. Very beautiful definition. Changes in economic resources and claims. What is your changes in economic resources and claims? What is meant by income? Increase in assets, right? Or decrease in liability, increase in assets or decrease in liability that result in increase in equity, other than those resulting to contribution from holder of equity claims. What does it mean? So increase in assets or decrease in liability, which results in increase in equity means net assets. Net assets. Friends, a company has issued a rights shares. A company has issued rights shares. By issuing a rights shares, is it by issuing a rights shares whether the net assets will increase? Whether the net assets, I mean to say in equity, whether the equity will increase? Yes, equity will increase. Yes. But whether this transaction is relating to the equity shareholder or other than equity shareholders, this transaction is related with the equity shareholders, right? This transaction is related with the equity shareholders, and hence it is not meeting the definition of income. What is the definition of income? Increase in assets or decrease in liability. Net net, resulting in increase in equity, but other than the transaction happening with the shareholders, right? But this transaction is happening with the shareholder, and hence it is not covering under income. So where it will go? It is not an income. It will directly go to the changes in equity. It will directly go to the statement of changes in equity. It will directly go to the reserves and surplus, equity share capital. Likewise, your expenses are the mirror image of income. Decrease in assets or increase in liability, net decrease in equity due to a transaction happening with the party other than the shareholder. The company has distributed dividend. Now you tell me whether this will resulting to decrease in equity or decrease in net assets or not. क्या equity, I mean to say net assets, dividend distribution से decrease होंगे या नहीं होंगे? बिल्कुल होंगे. Because your retained earning will go down, will be appropriated. Your net assets will go down, equity will go down. But this transaction is with shareholder or other than the shareholder? This transaction is with shareholder or other than the shareholder? I hope you guys are able to understand these things, right? Because you all are aware about this thing. The only thing is I am telling you the definition, right? So what will be your income and expense whenever your equity will increase or decrease, but of course not from the shareholder. It should be other than the shareholder. Yes, Rahul, you're right. In this case, since dividend is a transaction with the shareholder and hence it is not an expense, it will go into the other changes. It will go into where? It will go into the other changes in the economic resources and claims. It will directly go to the statement of changes in equity. It will directly go to the movement in reserves and surplus, movement in equity, right? So have you understood the definition of an asset, liability, equity, income and expense? So this is an equity. Equity means the transaction resulting from the changes in the economic resources and claims due to the shareholder as well as other than the shareholder. Why other than the shareholder? Because this retained earning will also go to the reserves and surplus, right? But what is income and expense? The transaction happening with the party other than the shareholder. Whenever there is an increase in assets or decrease in liability, decrease in assets or increase in liability. So this is the definition of income and expense. So asset, liability, income, expense, equity, is it clear to everyone or it is not clear? Guys, is it clear or not clear? Please confirm so that I'll move on. Just detail is given. I have already covered these things, right? I don't want to read this entire theory. Okay. Control, etc. I have already covered. The definition of liability, equity, income, expense. I have covered everything. Present obligation, contingent liability, right? So these are just given in detail. Yeah, Viraj, is it clear? So I got a confirmation from Rahul, Rohan, Radhika, Ashish. What about others, guys? Okay, thanks, Viraj. Yeah. Now coming to the recognition and derecognition, right? What is meant by recognition? Recognition is the process of capturing an item in the financial statement. That's all, right? So asset, liability, equity, income, and expense. If these items are meeting the definition of element of the financial statement, then it has to be captured in the financial statement. First of all, it has to be meet the definition of the financial. It has to meet the definition of the element of the financial statement, right? So recognition, as far as recognition is concerned, so we have discussed the element in detail: asset, liability, equity, income, and expense. And I've already briefed about the linkage, right? For example, in your opening balance sheet, there is an asset minus liability is equal to equity. In your statement of profit and loss, income minus expense is equal to profit, right? And in other changes in equity, so in changes in equity, your balance of P&L will go, and the other changes in equity will also be there, like dividend distribution, right issue, etc., right? So in other changes in equity will also be there. So if I will add my net income and expense, my net other changes in equity in the balance sheet, I will get a closing balance sheet, right? You all are aware. For example, if the company has incurred any expense, the company has incurred any income, it will flow to the asset, liability, or equity in the balance sheet, right? It will flow to the asset, liability, or equity in the balance sheet. Friend, for example, in case of a recognition of income, in case of a recognition of income, you have to credit income in the P&L. You have to credit income in the P&L. But in the balance sheet, either you will debit the asset or you will credit the liability, right? You will credit the liability. For example, you have written back the creditors. You have written back creditors. What will the accounting entry? Creditors account debit. You have debited the liability. Two, other income. Or let's say you have sold goods on credit. Debtor account debit. You have debited the asset. Two, revenue. So basically, this entire recognition process resulting into the capturing the element of the financial statement into the financial statement, right? And whenever you are capturing any income or expenses, it is resulting into the impacting the balance sheet item as well, right? So this is all about, this is all about this recognition thing, right? Recognition means recognizing the item which remain in the balance sheet. Okay. What is recognition criteria? So guys, if you will see in the respective standard, every standard is having a recognition criteria. And what is the recognition criteria? The asset or liability is recognized only if recognition provide user of the financial statement with information which is useful, means which is relevant as well as faithful representation. Example, PPE. If you will go to the definition of PPE in India 16, it is said that PPE are tangible item. PPE are the tangible item which is used for, which is held for use in the production or sale of goods and services, and which has to be used for more than 1 year. So it has to be shown in the non-current asset. It has to be recognized as an asset, right? If it is less than 1 year, probably it may be expensed off. Means मेरा within the year आया और within the year ही चला गया. But if it is for more than 1 year, it has to be there in the balance sheet. It has to be recognized as an asset, right? So going by the substance, it has to be recognized as a non-current asset. Why? Because it has to be used for more than 1 year. The company will receive the future economic benefit for more than 1 year. So friends, it says that an asset or liability has to be recognized only if the recognition provide a relevant and faithful representation, right? Is that clear? But the recognition criteria has to be given in the respective standard, right? This all things we have already understood. Okay. The control aspect should be there. The obligation, the benefit should be there. Okay. These are the things. What is a derecognition? We have discussed recognition means capturing the element of the financial statement into the financial statement. And as far as recognition is concerned, we talked about asset, liability, equity, income, and expense. What is a derecognition? Derecognition only happens with the asset or liability. Why? Because जो बैलेंस शीट में आ रहा है आप उसी को तो derecognize करोगे. Income and expense does not have any closing balance, but asset or liability will have a closing balance. Whatever is brought forward, you have to derecognize only that. You have to derecognize whatever exists only, right? So element of financial asset is asset, liability, which is getting derecognized. And what is meant by derecognition? When the entity loses control of all or part of the recognized asset. In that case, you have to derecognize an asset. For example, the company has sold the machinery. You have to derecognize. And same concept you will find in Ind AS 16, Ind AS 38, Ind AS 40. Liability. When you have to derecognize a liability, when no longer there is a present obligation, when there is no longer a present obligation will be there. In that case, you have to derecognize a liability. Right? Is that clear? Is that clear? Yes. Okay. You understand why derecognition concept is not there in income and expense standard, but it is there in your asset and liability standard. Coming to the measurement. The measurement is of two types. Measurement means you have understood that now I need to recognize this PP, but at what value? So the value is given by the measurement basis. So there are two kind of measurement basis. One is historical cost and one is current value. What is meant by historical cost? Historical cost means recognizing the asset or liability on the basis of the amount at the date of transaction. In many companies, when you go and see the land, value of the building, you will find when you go to the Tata Steel or Tata Motors annual report, you will find the value of the land is, let's say, 50 crores or 10 crores. But you know what is the actual value of the land? For example, in Connaught Place, you must have heard about the Connaught Place area in New Delhi. So the companies which have purchased the land or building in Connaught Place 40 years back, probably they would have purchased in 10 crores. Now the value is 1000 crores, right? But still they are showing that value of land and building at 10 crore only. It's an asset. It is every time it is coming in the balance sheet because this is a brought forward balances. So historical cost, because they are presenting on a historical cost basis. Historical cost means cost on the date of transaction with the changes in terms of consumption of asset. For example, there was a building which was purchased 50 years back. The cost was 10 crore, historical cost was 10 crore, but we are expecting the life of the building is 60 years. So every time the company is depreciating the building. So it is a historical cost which changes in the consumption of the asset. Or so which is a depreciation, or the debtor has been recognized at a historical cost, but you seems that okay, out of my 100 crores of portfolio of debtors, probably 5 crore will not pay me. So you are providing a provision for doubtful debt of 5 crore. So you are making a provision considering the changes in estimate, the changes in factual scenario, but your value, your measurement is same. Whatever you have recognized 10 years ago, 50 years ago, 2 years ago, 2 months ago, it is coming out at the same value, but you are just providing or you are depreciating or amortizing. Right? This is known as a historical cost. But coming to the same example, when in the Connaught Place, this building was purchased or land was purchased for 10 crore, but today it is a value of 1000 crores. So if the company would have opted for revaluation model or fair value model, it will shifted from historical cost to current value. So what is meant by current value? The current value will be either your fair value, right? What is the fair value? Fair value means today, if I have to exit if I have to sell this building today, what amount I will fetch? This is known as a fair value. So this fair value definition is given in Ind AS 113. And when you say that this fair value when you say that this fair value is a exit price model मतलब आज अगर मैं इस एसेट को मार्केट में बेचूं तो कितना मिलेगा, that is known as a fair value. So current value could be a fair value, or current value could be a value in use. Current value could be a value in use. What is a value in use? It's a present value of future cash flows. When you see Ind AS 36, it uses the word value in use. So value in use means from this asset, instead of selling this asset, instead of exiting from this asset, if you will use this asset into the entire lifetime, what cash flow you will receive. And when you discount this cash flow, you will have a value in use. That is the value of the asset. That is the current value. Or current cost. What is meant by current cost? Replacement cost. Replacement cost. If today I am buying the same asset, I'm replacing the asset, what cost I have to incur? For example, you must have seen you have an old TV, old fridge, old AC. So just last month, I have replaced my old refrigerator. Okay. So I was having a Samsung refrigerator and I bought a bigger Samsung refrigerator. So when I went to the, I would say Vijay store, Vijay Sales or Sargam Electronic or Chroma, they told me that the cost of this refrigerator is 35,000 rupees. What is that? That is a fair value. But they have told me if you will exchange your old refrigerator and you will buy this new refrigerator, it will cost you 25,000 rupees. Or you must have seen in case of mobile phones, right? In case of mobile phones, you want to buy a newer version, you can replace the older version of iPhone, and you get a discount of 10,000 or 15,000 rupees. What is that? That is a replacement cost. So the replacement cost is 25,000 rupees. The fair value is 35,000 rupees. The value in use is, for example, whatever cash flow I am earning from this particular asset, that is a value in use. Have you understood this thing, guys? Have you understood this thing? Have you understood or not understood? I have told you all the examples of historical cost, current value. Current value means current cost, fair value, value in use. So friends, when you look at the standard, now which measurement basis has to be followed? First of all, the measurement basis has to be followed in such a manner. It will provide a faithful representation and it will provide a relevant financial information. Investment, for example, investment. What is the purpose of investment? To earn passive income, to have a capital appreciation, right? So do you think that applying a historical cost method for investment, is it a right thing? Answer is no. Because the purpose of the investment is to earn money and is to have a capital appreciation. So investment has to be measured at fair value as per Ind AS 109. Second, building or fixed asset. Are you having a fixed asset for the purpose of selling? Answer is no. You are having a fixed asset for long-term purposes, for earning, for long-term purposes, for having a future economic benefit. So is it right to always recognize this fixed asset at fair value? Answer is no. Right? Answer is no. So in that case, the most appropriate method is historical cost, and that is why I would say 95% of the Indian companies are showing it at historical cost, right? But of course, revaluation model is there. But if you are opting for revaluation model, you have to do some sort of disclosures, right? Is that clear? This is all about your asset and liability and equity measurement. Okay. So this theory is given. I'm not dive into this theory. Okay. But whatever I've told you, this is the crux of this thing. Yeah. Now let's talk about presentation and disclosures, objectives and principles. Presentation and disclosure. Every standard is covering presentation and disclosure generally. Guys, I hope you are enjoying the session. I hope you are able to understand the concepts, right? Presentation and disclosure is again very important. What is meant by presentation? How you are presenting the information, how you are presenting the element of the financial statement into the financial statement, right? How you are presenting so that the information is understandable, information is verifiable, information is comparable, right? Information is consistent, right? So presentation and disclosure the presentation talks about the classification. The classification has to be appropriate. For example, non-current and current, right? For example, the classification into various items. The material item has to be presented separately, right? So the presentation has to be according to the nature of the business, according to the nature of the company as well, according to the requirement of the relevant regulatory environment. Coming to the disclosure, the important disclosure, for example, related party. Related party transactions are nowhere shown in the balance sheet, P&L, cash flow, statement of changes in equity. It is nowhere reflected separately. But how will you able to understand the related party transaction? By looking at the disclosure. Contingent liability. It is an off balance sheet item. But how will you know about that? Yes, this company would have such sort of exposure by looking at the notes to accounts, right? So friends, if you will talk about the respective standard only talks about the relevant presentation and disclosure of the relevant item. PP, intangible, taxes, related party, contingent liability, provisions. But this framework talks about the presentation and disclosure objective and principle. What could be the objective? The objective is that the user of the financial statement will be able to understand the information, will be able to compare the information, right? Will be able to take the decision on the basis of that information, will be able to have all the sufficient information, disclosures, which helps them in taking the appropriate decisions, right? So this is the bigger thing which is given in the framework. After reading the framework, just open Ind AS 16. Go to the disclosure part. You will be able to connect. Oh, whatever is written in the framework, the disclosure has been drafted in the same manner, right? Is that clear? I'm not repeating again because we are always reading the presentation and disclosure concept in all the Ind AS, right? Now, I'm coming to a new concept of capital and capital maintenance, and this is the last concept in this framework, right? This is a capital and capital maintenance. If capital, you all are, or you all have heard about capital, right? Now, capital is equity shareholder funds, I would say, the capital. Now, this capital maintenance have two concepts, which is financial concept and physical concept. Financial concept and physical concept. Okay. Now let me make you understand in a different manner. Financial concept and physical concept. Let's say, Viraj, you are having 100 rupees in your pocket today, right? And tomorrow your father will give you 50 rupees. Okay. So what is the closing balance in your pocket at the end of tomorrow? 150 rupees. So going by the financial concept, you have a growth of rupees 50. You have a growth of rupees 50. You have earned a profit of rupees 50. Your financial capital has gone up by 50 rupees. This is known as a financial capital. This is known as a financial concept of increase in capital. Now, same example, Viraj. You are having 100 rupees in your pocket and you wanted to buy a book. You wanted to buy a book. And you are asking money from your father, but your father has not given you money today. And the price of the book was 100 rupees. Right? Let's say the price of the book was 100 rupees. So today you are having 100 rupees, you can bought one book. Okay. Tomorrow you have not bought the book today. You have not bought the book today. but you had 100 rupees and the price of the book was 100 rupees. Tomorrow your father has heard that you want some money and he has given you 50 rupees. So now how much money you are having? 150 rupees. But the price of the book has gone up to 180 rupees. The price of the book has gone up by 180 rupees. So in this case, your purchasing power, in spite of the fact you are having a bigger money, you are having a higher amount, but still your purchasing power has gone down. Your purchasing power has gone down due to inflation, right? What does it mean? Your purchasing power has gone down due to inflation. So again, in terms of financial concept, in the first case, still your money has been increased, but your purchasing power has gone down. That is why, when you meet any financial analyst or when you meet any financial brilliant person, and he will tell you, let's say Viraj, you are 25 years old, for example, and you will retire at the age of 58, right? So he will tell you that how much money you have to invest today so that you will retire very happily. For example, if for living a good life you need 50,000 rupees today, you will not be able to survive into the same living condition after 30 years. Probably the 50,000 rupees which you require today, it will become 5 lakh rupees after 30 years. So you have to invest according to the future. Okay. Why? Because in future there is inflation as well. Your purchasing power will go down, right? Your purchasing power will go down. You must have heard from your grandfather or grandmother that we have purchased a ghee. We have purchased desi ghee at 50 rupees per kg. And now the desi ghee costed around 500 or 600 rupees per kg, right? You must have heard about from your father that I purchased my first car, Maruti 800, at 1.5 lakh rupees. Today, when you go to buy Maruti car, it will cost you 5 lakh rupees, right? So friends, the financial concept is a concept which takes care of two aspects. One is nominal value concept and your purchasing power concept. 100 to 150 going by the nominal value concept, the capital is increasing. Going by the purchasing power concept, the capital is decreasing, right? Now, same example from the physical concept. So the financial capital concept is more about the net assets, increase or decrease in net assets. The physical capital concept is more about the productive capacity. For example, when you had 100 rupees, Viraj, you had bought you have bought one book. Okay. You have bought one book. And let's say you have bought one book and you have sold that book to your friend at 100 rupees itself. Your friend was in urgent need of book. You have sold that book to your friend. And you have sold that book to your friend at 120 rupees, let's say. You have earned 20 rupees profit. This 100 become 120. But tomorrow, when you go to buy that book in the market, the price has become 180. So your productive capacity has gone down. Your productive capacity has gone down. Yesterday, you were having one unit in 100 rupees, but now you will have only 0.6 or 0.7 unit in 120 rupees. So it means your productive capacity has gone down. So probably going by the nominal financial concept, you have done pretty well. 100 becomes 120. But going by the physical concept, your operating capacity has gone down. So your physical units, your physical capacity from 1 unit has deteriorated to 0.7 or 0.8 unit. So this is known as a physical capital concept. Let's understand this again with the help of this illustration, right? A trader commenced business on 1st January 2001 with 12,000 represented by 6,000 units of a certain product at rupees 2 per unit. So the business was started with introducing a capital of rupees 12,000, and with 12,000 this businessman has purchased 6,000 unit of goods at rupees 2 per unit. During the year 2001, he sold these units at rupees 3 per unit and had withdrawn rupees 6,000. right? So 12,000 rupees, 6,000 units, and he sold these all units at 3 rupees per unit and has also withdrawn 6,000 rupees, right? And has also withdrawn 6,000 rupees. So let me take you on my PPT and let's discuss something. Capital. Financial capital. So don't worry, students. I'll be able to wrap up this session in another 5 to 10 minutes. Okay. Physical capital. So this is financial capital maintenance, physical capital maintenance. Financial capital, nominal value approach, purchasing power approach. When I come to physical capital, it is more on the basis of operating capacity. If it has gone up, means going by the physical capital concept, the company is performing very well. If it has gone down, means going by the physical capital concept, the company has not doing well. So in this case, the opening capital, in this case, the opening capital was 12,000 rupees, right? And out of 12,000 rupees, the 6,000 unit have been purchased at the rate of rupees 2 per unit. It was sold. This 6,000 unit was sold at the rate of 3 per unit, means 18,000 rupees we have earned. 18,000 rupees we have earned, right? So the closing capital would be 18,000, but there was a drawing of 6,000, means the closing capital become 12,000 only. And friends, when I'm talking about capital, I'm not talking about the profit only. I am talking about the closing capital. I am talking about the capital after distributions, net capital. So the opening was 12,000, the closing was 12,000. It means going by the nominal value approach, the company has not performed anything. Means the capital, whatever was the opening capital, that is the only closing capital. Assuming this 2 rupees is still constant. So the purchasing power in the opening was 6,000 unit. The purchasing power in the closing is also 6,000 unit, right? So going by the purchasing power concept, the company is just constant. Going by the operating concept, going by the operating capacity concept, the company is also constant. The company has not done well, the company has not done bad, right? The company has not done bad as well, right? So in this case, if I look at from the nominal value perspective, purchasing power perspective, operating capacity perspective, the capital is just constant. The capital is same. Okay. Right? The capital is same. Right. Now, sir, then what will be the difference between purchasing power and operating capacity? So you have understood. In here, I am talking more about the physical units. Here I am talking about the nominal value and purchasing power, right? So now let's talk about from the different perspective, right? In this particular case, in this particular example, let's say in the financial capital concept, we understood that the trader can start by purchasing 6,000 unit 2 per unit again for selling them at 3 per unit. The whole process can repeat endlessly if there is no change in the purchase price of the product. If there is a change in the purchase price of product, then what will happen? Let's discuss. Previous example, suppose that the average price indices at the beginning and at the end of the year are 100 and 120. There was an inflation. And the price index becomes 120 from 100. It becomes 120 from 100, right? The purchase price indices becomes 120 from 100. What does it mean? It means there is an inflation. Means the opening capital was 12,000 rupees. There was a sale of 18,000, right? But drawing was for 6,000, right? So closing capital was 12,000 only. It is 12,000 only, right? So in this case, if you will see, for maintaining the purchasing power, because there is a 20% inflation, the price index becomes 120. So how much money I should have to maintain my purchasing power? 12,000 divided by 100 into 120, it comes out at 14,400. It comes out at 14,400. What does it mean? It means my purchasing power has gone down because my opening capital, going by the nominal value, my capital is constant, but going by the purchasing power, my capital has been deteriorated. My capital has been deteriorated, right? So if I have to maintain my capital, I have to reduce my drawing. Have you understood? So in case of inflation, in case of change in price concept, going by the purchasing power, the situation is deteriorated because for maintaining the same purchasing power, I have to get 14,400 rupees at the end of my capital, at the as a closing capital at the end, right? Same example, let's carry on. Opening capital 12,000, closing capital 12,000. In opening capital, I was able to purchase 6,000 unit at the rate of rupees 2. I have sold at the 3 rupees, right? 6,000 rupees I have withdrawn. Closing capital still 12,000 rupees. But now the price has moved from 2.5 rupees. From 2, it was increased to 2.5 rupees. So with this 12,000, now I will not be able to buy. I will not be able to buy 6,000 units. How much unit I will be able to buy? How much unit I will be able to buy? 4,400 unit I will be able to buy from this 12,000 unit. So this physical capital concept is more from the operating capacity, right? So I have moved from 6,000 units, not from the capital perspective, from the unit perspective, from the operating capacity perspective, from 6,000 unit. Now I am able to operate only on 4,400 units. So going by the physical capital concept, the company has deteriorated. Is that clear, friend? Capital and capital maintenance, is that clear? Is that clear? Nominal value approach, purchasing power approach, and physical capital maintenance approach, is that clear to all of you? Is that clear or not clear? This was all about financial reporting. In the conceptual framework, I have discussed the objective of general purpose financial reporting, the qualitative characteristics of financial statement, which is relevant and faithful representation and enhancing characteristics. Then I've discussed financial statement and reporting entity. I have discussed element of financial statement along with definitions. I have discussed recognition and derecognition. I have discussed measurement, which is historical cost and current cost. I have discussed presentation and disclosure, and I have discussed concept of capital and capital maintenance. That is all from my side, my dear friend. Let me know if you have any question. Otherwise, I will be happy to conclude the session. Thank you so much. 6 students have cleared that they have understood. And Rahul, for such a wonderful feedback. I'm glad that you have able to understand this entire session in detail. Thank you so much. Okay, guys. So I can see there is no any query. There is no any question. I will be happy to conclude the session. Thank you so much. Stay happy. Stay safe. Bye bye. Take care.